right, welcome back. This week we're going to be going over Trading Experts Step 4, the game planning book. We're going to go over a couple of the major lessons in this book and some of the major topics with some real trading examples that we're going to break through in the next 20-30 minutes. And as we mentioned in the prior classes we've done, if you do watch this video, you do complete the final task. We still recommend that you do read all these lessons, as there's a lot more value in them than what I can quickly summarize in this call. But that if you do complete the final task and we know you've done it correctly, we have no problem moving up to step 5 into chart reading. So again, we do have a playlist that is posted in the Discord group where you can watch some of the other videos that break down some of the other major lessons we've already gone over. And for the ones that we haven't gone over, we'll go over those now today. So one of the first lessons we're going to go over is what is a game plan, obviously the title of the book. And as we mentioned in prior videos, a game plan comprised of 3 key components. It's going to be your entry price. From there, you want to determine your stop price or your exit. And lastly, it's going to be your target price. Those are the 3 simple and key things you need to put together before putting any orders into your brokerage account. And as we go through this book, we'll go over why we focus on percentages, why we try to look to risk 1 to 5% in our swing trading ideas with the goal to make 5 to 25%. These will touch on points where we focus on the percentages, where we focus on proper risk reward. And this all revolves around the game plan. It all starts there. That's what is required before you put a trade on. For most individuals, they do this backwards. They hear about a stock or an investment from a friend or a peer. They invest in it, and then they try to form the game plan after the fact. And then they start to make emotional decisions based off what the investment is doing. When you can do that beforehand, before any money has left your brokerage account in exchange for the investment, you've made that plan of what you're going to do, you will remove some of the emotional aspect of the investing side of it. Not all of it, of course, but most of it, because you're going in with a plan. You're not forming the plan when the game is already being started to play. So the first thing we want to go over this lesson is to buy or not to buy. Again, this lesson goes over an example where our main focus is to focus on the more expensive names when the newer trader typically gravitates towards the cheaper ones. And the reason for that is quite simple, is that when you're starting out, you think certain things are important when they aren't as important. And one of the major things is if the assumption or the incorrect assumption is that with the more shares of a name that you have, you can make more money, when it's really the dollar amount that's going to dictate that. So in this chapter, we go over an example where we compare Caterpillar. In this example, Caterpillar is already up 100% in that current year, near all-time highs. It seemed very expensive. It seemed very overbought, as some would expect. While on the flip side, General Electric was 25% off its 52-week highs, was near support. It looked like a phenomenal deal. When we fast forward some time, Caterpillar trades 50% higher in the same period, while GE trades 75% lower after that initial 25% drop. And if we look at it today, and again, we originally wrote this lesson back in 2018. This is more than 5 years later. The lesson is still as relevant as it was nearly half a decade ago. Caterpillar is still even 100% higher than where it was 5 years ago after that run up. And GE has gone nowhere. Now it looks as if it did. It looks like it's a $100 stock, but they split the stock, making it appear more expensive. So GE technically is still trading at basically the same price. It's trading around $12 a share pre-split, where in this lesson it was at $7. So half a decade later, Caterpillar, that was already up 100% at the time, is trading 100% higher, while GE, that was trading 20% off its current high, had fallen by 75%, and is still in that very cheap, Mickey Mouse or Happy Meal price stock that we try to avoid. And hopefully the point of this lesson is just to make you focus on stocks that are top right on its daily chart. So if we look at GE, and this is going to be top right, very visually appealing, very easy to spot. If the chart is up here, this is a great sign. When it's bottom right, this is where they appear cheap. They look like these great deals, but that's very rarely the case. Right now, if we put in Caterpillar, you can see top right. This is, it's a strong stock. It's been strong. It's been strong since the day it came out. you end up you'll get bailed out more in these names that are top right than trying to hunt for the bargains when they're in the lower right-hand corner of their daily chart. So again, that's that main point. Focus on the more expensive stocks, relatively speaking. Try to avoid the stocks that are under $30 a share. Sometimes there's stocks in the 20s that can be some exceptions to the rule, but typically the higher the share price you can focus on, the tighter the risk you can find in setups where you'll have the risk reward that typically will fall in your favor. So when Caterpillar looked expensive, and we're going to zoom back to here, when it looked expensive after the 100% run up, there was real swing trading setups in here where you can buy this name and risk 1 to 5% and achieve 30, 40, 50, if you're patient enough, 100% returns, where with the cheaper names, the GEs of the world, they look like they're cheap. And this would have been the stock around this period. At this time, it looked like a great deal. And then it became an even better deal. And then it became an even better deal. And it continued to become a better deal with time as it continued to trade lower. And this is why, even if the stock is 50% off highs, it doesn't mean it cannot still fall another 50% from that price. And even when it gets to that price, it does not mean it still can't fall another 50% from that price. So that's why we really want to avoid the bargain-based hunting. We want to focus top right in a name that's bull flagging, which leads us right, again, I'm sorry for this cough, guys. We're leading right in this bull flag example. So we'll go over two relevant bull flags right now in the market that are not 5 years old. We have one right now. We have this EXAS that we can see this bull flag forming. We can see a very defined period where the stock is trading horizontally. It's consolidating within a range after an initial run up. So EXAS had run up nearly 100% from its November lows. It had gotten exhausted. It could no longer continue that uptrend. It now starts to base out or flag. And then and that's like a pausing period. And we want to wait for that next breakout and purchase through the break of that flag, place our stop below the pivot, and throw it accordingly. So this is one of the key things. If you can master this one pattern alone, you can always find this pattern in the market. Out of the 1,000 stocks out there, you can always find this pattern where you can define your risk. You can form a very simple game plan. We can see here that 70 is resistance. That's step one. We know our entry. We know if we're wrong at this point, 60 really is the out. Maybe in a few weeks, you might be able to give it for 63. If it tightens up even further, maybe you give it for 65. So say this stock tomorrow trades through 70. The low at the time is 65. Step one, your entry is 70. Your risk is $5. And from there, you want to aim to have 5-to-1 risk reward. So if you're risking $5, you want to make 25, and that will give you a 5-to-1 risk reward of $95 a share would be where you want to look to take profits. Realistically, given the range this name has been trading in between 60 to 70, realistically in the short term, the measure move of this really is to about 80, but it's a non-move higher. So that's where you want to find those setups where you can risk. If your realistic target is $10 higher in the short term, and you want to make 5-to-1, you need to find this entry where you can risk $2. That might mean finding a support buyback, buying it up off of 60 versus 60 where you can risk $2. But these are the factors of this book that we're going to explain of that simple game plan and how we're breaking apart each component from the entry, determining the stop, finding the measure move of the pattern, and figuring out if that risk reward makes sense. Again, every trade is not going to be 5-to-1. There's going to be trades where it's 2-to-1 or it's 3-to-1, sometimes 1-to-1. But you do not want to go into the trade with the mindset that you're going to risk $5 to make $5. You don't want to risk $1 to make $1. You need to go into these opportunities where realistically you can look at that trade and see that you can make 5-to-1 on that risk. And this is one of those reasons why we avoid those GEs of the world when they're bottom right and they're the cheaper stocks, because you end up taking far more risk in the trade than what you think. Where the more expensive top right names, it'd be very hard to lose 50%, even buying the high-end Caterpillar. I don't want to say it's impossible, because that absolutely certainly is, but you'd have to buy the absolute high, hold it to the absolute low of that year. It's much more difficult to really mess up buying a top right name with proper game planning. When with the cheaper names, even with the game plan, the stock can still gap down dramatically, and you end up taking much more risk in the name. So with that, we're going to move on to one more example, again, of this top right bull flag game planning example. Again, EXAS was a name that's setting up, has not broken out yet. This MSI is a name that has broken out. We can see the flag that formed here recently. We can see that, again, great sign that it put an all-time high. It retested it. Third time it tested, fourth time it went. We refer to this third time's a charm, where we never want to be chasing a new all-time high. We never want to do that. We very rarely ever want to buy the retest. That's often the time when this crowd who chased the first time, who thought the stock was going to go up dramatically and then sat through this drop, this 20, 30% drop, and is now back to even. This is often the crowd creating that resistance who are now getting rid of that position for break even. At this point, it was to make 50%, make 100%. But after that year of it dropping, when it gets back to your price, and we've all done this, or if you've traded enough, you more likely have done this, as I've done it countless times, is now you just want your money back. That's where resistance is created. And eventually this crowd leaves. This crowd also leaves. And third, fourth, fifth, sixth, seventh attempt at that resistance level increases the probability that it should trade higher. So here it took 1, 2, 3, 4 attempts to break higher. Now, if you were to buy this name on that fourth attempt, and we're going to shift into trailing stops with this particular breakout, is that once you're in this name, you bought it this day. At that time, this was your pivot low. So you were buying, we're going to say 270 just to keep the numbers very simple. Your stop was 265. So your risk here was $5. So you have $5 risk in the trade. Let me just put a little note here so it's easier to, when you're visually watching this, to follow along. So you have $5 risk. Your entry is 270. That was step one of the game plan. Step two is determining you're out. That was 265. That's $5 risk. If we want to make 5 to 1 risk reward, that means our target would be $25 higher, which basically, again, keeping the math very simple, your target is going to be $300 a share. And over the last 2 weeks, the stock has gotten very close to that realistic 5 to 1 risk reward. Now, when we talk about trailing stops, there's something we'll get more into when you start to trade. Again, this takes real time in positions to do. Again, we are going to explain it in the book, but this is something that when you're really investing is really when you're going to understand these lessons. But the day that you're in this trade, initially your stop is here, 265. As the stock starts to break out, this is when you can start to find pivot lows that form in the name to move your stop up. The one key thing when you do move your stop up is you want to wait until later in the afternoon to do that. This is not something that at 9:31 in the morning you should be raising your stop. Nothing has occurred enough during that day where you're going to be more anticipating the moves of the stock than reacting to it. So if we were to say it's been now a week and the stock is now trading at in a 285 area, we don't know where this pivot's formed yet, but we do know if this trade does reverse and it comes back to our price, it's more than likely going to come back to our stop. So at this point in the trade, we're in a winning position. It's safe that we can now raise that stop to break even. So we were initially risking $5. Now we've raised the risk to 0. Again, it can still gap down below that level. A ton of things can still occur, but with normal trading aside, you can be certain that that stop should work for you unless it gaps down to 200 or something crazy occurs. So we've now limited our risk to break even. And that is a big goal that we try to instill with most of our members, is to hold your winners and systematically try to limit the risk to make the losses de minimis as possible. So as the name is traded, once it starts to break out of this flag that was formed, and let me zoom in some more, so it's easier to follow along. Once this action has occurred and this new high has been taken out this day, the stock is back to breaking out. We now have this new pivot low. So now this day of trading in MSI, it takes out the little flag of form, it's trading higher. we can now raise that stop that was down here at break even underneath this pivot. So now our stop was 270. Now we can raise it up to 280. Now, as you already know from the Pennywise lesson in book 3, the stop is never going to be on 280. It's going to be a few cents below. So it's going to be 279.89. And now as the stock continues to trade higher, we wait for that next pivot to form, which as of late is right here. So 285. So now you can raise the stop again. Now, again, this is not foolproof. This is not going to work perfectly with every name. And that's when it comes to your own experience and your own risk tolerance with your trades. There might be trades where you're raising stops daily. There might be stops you're raising weekly. Some you might be raising monthly. It all depends on the trade. There's always going to be a very dynamic process. This is not cut and dry where every day you raise your stop. And that's where this lesson, you really will start to hone and perfect the art of trailing your winners from real experience in your trades. And the names that you trade, that's where you're going to really pick up this lesson in real time, from your trades. So again, we did touch on a couple of topics here. Again, we really hammered in 5-to-1 risk reward, risk elastic. Again, we want to aim for those trades where we can risk 1, 2, 3, 5%, but have the ability to make 5-to-1, but not capping it there. If the name still wants to trade higher, that's that risk elasticity where in these more expensive names, the odds of these names going up 50, 100% in a year from that level isn't that far-fetched, given the name has been a leader, up until that point. So moving on, again, we touched on these topics about trailing stops. Again, a lot of this you will learn from putting on real trades. Key thing, though, you want to remember is having, focusing on those pivot lows. And when you do raise your stops, waiting until the afternoon. It is not something you want to do first thing off the open. And let's see, we got shakeout is going to be the last topic on here that we haven't touched upon. Again, we already touched on the percentages. And I will give you a recent example of a trade that I'm currently in that actually shook me out prior. So this OPCH, again, we're talking about a very simple bull flag pattern. And we can see this earnings bull flag that formed. We're talking about earnings flag. OPCH had earnings. The stock gapped up on earnings, which is a good sign. And then it starts to flag out. Typically, if you've seen any of our parody video about earnings, you want to typically wait 4 to 6 weeks for a name to flag out during earnings before you should expect a breakout. This stock gapped up end of February. It's now the end of March, or end of April. That time has elapsed where it's been flagging long enough after earnings that a potential breakout is probably in the cards. Now, I was, again, too early to this trade. At that time, 31 quarter was the out. But again, we don't want to put stops above the whole number. So I was willing to give it a little bit more room versus 31 with a 30.89 stop. Again, we never put stops on the whole number. Now, for nearly 2 weeks, the stock broke above 32 and continued to flag in between, bull flag between 32 and 31. It was in this consolidation period. All normal action with the goal of adding through 32 when it was ready to break. The problem, though, was it broke down under 31 and shook me out. It traded below that area of where I was willing to risk to name the proper risk I was willing to give this name. It shook me out and immediately went back. So right off the open, my stop for 2 weeks had been under $31. And for 2 weeks, it had never been tested. This day, it shook me out, shook out a few other buyers, a few other sellers, and immediately went back. How this name closed that day showed me this was a shakeout. If it was not a shakeout and the stock was breaking down, it would have been more like an example like this over here, where it came into support and broke and closed lower dramatically. This is why you want to have those stops in place, because if this was to occur, I would be very happy with selling at 32 and taking that loss, then sit with this thing down to 28. But there are times, like in this trade, that it hit 31, which was where my stop was at, and it did not want to go lower. But these are things that it's hard to anticipate in the moment. You have to respect that game plan. And my respect with this trade was to give it $1 risk. It headed lower. I took my loss and moved on. When I saw this close and the following gap up, that was the confirmation that this was the shakeout. This was shaking at the weak hands. I'm the weak hand in this example because I was only willing to give it $1 worth of risk. And the reason for that, again, it's a $30 name. If I give this down to 30, which would have kept me in the trade, that's $2 risk. This stock needs to go to nearly 42 for me to achieve 5-to-1 risk reward. And realistically, this name is probably not going to get there within the time I'm going to be in this swing. The stock needs to retest and break this prior high and do a lot more before it's going to really get up there. And that's where I can keep, where I want to keep the risk tighter, risking $1, where this retesting this high and pushing a 37 would give me 5-to-1. That seemed more realistic in the trade than hoping and praying it's going to, trade 10 points higher. But this is the, I had to be consistent. I did buy this thing back and I will still trade it out accordingly. So this is a good example of shakeouts. This will happen in trading, especially for a swing trader. Shakeouts are part of the game, but respecting your stop and having them in place, there will be times you get shaken out and it'll be frustrating, but there will also be times like this arrow over here that when the stock is really rolling over and is bound to trade lower, you'll be very thankful that you took whatever that percentage loss was before having to sit through further pain. So these are the major points, again, of this book that we want to hammer in. We want to hammer in focusing on the game plan prior to putting the trade on. It is great to write it down on pen and paper. I still write my trades down every day on pen and paper: entry, stop, and target. Once you're in the position, enter your stop. After a few days of trading have occurred, if it's trading in your favor and you have a new pivot low, you can raise that stop. You do want to be aiming for 5-to-1 risk reward. And you want to be keeping that parameter of risk where you can risk 1 to 5% in a given idea, where making 5 to 25% is a realistic outcome in the name. And these are all things that we can find when we focus on the more expensive names. $30 plus, but really even higher, 50, 60, 70, 100, $200 names. CRM is a good example even right now. This is a name that we were looking at this week. It hasn't broken out yet. We can buy this through 200. Again, we can see this was the high. We don't buy the first high. We do not buy the retest. So we're not looking at it here. But the third, fourth attempt is when we're looking to buy that name through that flag and define that risk. So these are these reasons when you can find these lower risk opportunities in the names that appear to be more expensive than the names that seem to be cheaper, and when in reality often are much more risky. So I'm going to keep it short and sweet this week. Again, I'll open up to Steve and Matt. If you guys have any specific questions, you can definitely go over those now.
Yeah, let's give them a minute to type. Last time we closed it up while someone was typing a question. So let's see.
I'm just here for the review.
All right, cool.
All right, cool. All right, Steve, we'll give you another couple seconds. If you have any questions, we can go over them now.
Something I really want to key in that you mentioned, Bennett, was the 5-to-1 risk reward ratio, and understanding that it's not just, okay, I have my entry, I have my stop, and now I'm just going to aim for 5 times whatever I'm risking. You have to really take it one step above that and really make sure you're looking at the chart and asking yourself, well, is that target even an attainable target, right? Because just putting it, let's say, you're risking 7% and you're aiming to make 35. It's like, well, what's to tell you it's actually going to make that 35% move in the swing kind of time frame that you're looking for? So it's really a simple way that I like to look at it, especially if it's not at all-time highs, is look left, right? Look where the chart has been before. Find those previous areas of resistance, because usually at those previous areas of resistance, you can expect some resistance again. So that's where it makes a lot more sense, and it can help solidify whether a trade is worth taking or not, right? Because if you have an entry and you have your stop, and then you see where the 5-to-1 or 3-to-1 target is, and you can tell that it doesn't really make sense or doesn't seem attainable, you're probably better off passing on the trade, which will in turn help you kind of build that discipline of passing on non-A plus trades. Sometimes it's a B plus or an A, which can be good, but most of the time not good enough, right? So you're probably better off staying in cash, waiting for those real A plus setups where you have that attainable 5-to-1 target, and then strike.
100%. So again, lastly, again, if you guys have watched this, I'm going to briefly read off the questions in this test that once you answer it correctly in the Discord group, or you post them in the comments on YouTube where this video will be posted, we can move you up to step 5. So the questions are going to be, why do we aim for 5-to-1 risk reward in the trade? Why do we cut our losers and let our winners ride? And that's using that, using the trailing stop methodology. We'd like you to describe your A+ setup. Can we went over the bull flag, hopefully in enough detail in this video that you can explain that bull flag pattern and why that is. We'd like you to try to formulate your own game plan of your own A+ setup. If you have your watch list you've created earlier in the program, scan through it, whether it's a Dow 30 or the S&P 500 or your favorite stock at the moment. Try to define your current game plan. And again, this can be a little bit of a harder topic to do. And if you want to find a prior breakout, like we showed some examples of names that had already gone, MSI, Caterpillar, things like that, that is okay. Just show where the proper entry was, what your game plan would have been. Again, it's a little hindsight to take with a grain of salt, but as long as you can spot and form these topics here, this is the main point. We want you to be able to spot these setups, form these game plans, and see what they can do. And again, a couple of these other lessons here, I'm going to copy paste them in. They're multiple choice. We want to go over order types, things like that. So hopefully you guys found this video helpful. Next week, we're going to be doing step 5 chart reading. Again, for those who did watch this live with us today, you can post your answer in the group. Have you watched this? And we'll move you up so you can join us next week as well. So hope you guys found this helpful, and we'll see you guys next week.
Could I ask you one quick question before you jump off?
Yeah, of course.
So kind of in one of those books, it was talking about kind of following up stops. So you were talking about with Salesforce or CRM, you were hoping to see it kind of break out of that level. So to me, it looked like there might be another level of resistance somewhere, maybe around the 220 mark. And so if you're moving with that, moving your stop up day by day, kind of maybe potentially to the close, the prior day's close, where do you kind of get off the hopium that you're going to break through that 220 level to, let's see, where's the next, maybe the 240-ish level? Looks like maybe another one.
So one thing, it's not the prior day's close. It would be the prior day's low. And then you might have just used the wrong word.
Sorry. Yeah.
That's okay. Yeah. But so here again, this is where, okay, so we're seeing this 200 level flag that is still forming. It's not fully developed yet because again, it put in the high, it has retested it. We still need a few more attempts here. Now in the short term, yeah, very realistically, the move really here would be to 220 in the short term. So that's where, okay, your upside's 20 points from here. I need to be able to find the entry where I can risk, $3, $4, $5 in this name. So as of right now, we'll say like tomorrow, CRM opens above 195 and it continues to flag for the next week between this area. Let me zoom in a bit more so it's a little easier to visually follow along of what we're looking at. So we're going to pretend 195 holds, continues to trade in between 200 195, and we can risk the $5 here. So I can risk the $5 here. I know this is my target 220. That's a very realistic move in this name, and especially to that prior pivot high area. But that's where, again, it's going to be dynamic. It's not going to just be every day I'm going to raise it low a day. We don't know how it's going to trade. But that's where for now, if it was to go tomorrow up through 200, as of today, yeah, it's going to be 195. If it goes up to we'll say 210, pulls back to 205, and then starts to trade back up higher and then trades above 210, well, now I know I can raise my stop to 205. And again, like I haven't mentioned before, it's, there's not a gun to my head that says I have to only sell 220 and nothing else. My biggest focus with my trades, I'm going in wanting to make 5-to-1, but I'm also trying to limit my risk to break even as quickly as possible, but when it makes sense to do so. I'm not just going to blindly buy 200 and then it closes at 201 and raise it to break even. I want to see something. I want to see this name get to 210 or 208 and be bullish engulfing for 2 days in a row. Okay, now it makes sense to raise it to break even, because if it was to pull back, 2 back-to-back bullish engulfing days and it's coming back to my price, well, guess what? It's probably come back to this pivot low anyways, because it's not as important for you or I. For our swing trade, it's important. But in the grand scheme of things, no one cares about this 195 compared to those who care about, say, 125. So that's something when it comes to the swing trading part of it, we want to respect our stops. But we also have to be aware that other than active traders, most are not going to care about those price levels. And that's why with my trades, I try to limit the winning trades to break even quickly, because if they do roll over and they come back to my price, very rarely is this name or most short-term swings, is it going to go to 220 or 215, come back to my price, respect the stop, and then trade higher. It's like we're asking for too many things. We're trying to just get like that directional move in one way without having to make it too complicated. So by waiting for those pivots to form, by waiting to raise your stop to either the prior lower day, the current lower day, or the recent pivot low, makes it very systematic, but it does come into your own trading style. So we're trying to give you the broader idea. You might like prior lower day stop. You might like lower day. You might like the prior pivot low, but that's going to be your own risk tolerance and your, conviction in the idea or that name itself. So like for CRM, this is a name I buy every day in my long-term account. I have much more conviction in a name like CRM than OPCH, which is just more of a random swing trade. That I'll be a little bit tighter with this name because it's just a technical pattern, where CRM is also a name that within the next year or two, I have an alert here. I'll take profits. I'll retest. When it retests the all-time high, I'll take profits in my long-term position in this name, because that's where this name is headed in time. In the short term, yes, it'll probably get to 220, I get to 240, but I don't know if it will get there within what I'm willing to risk in that name. And that's why I'm trying to define that risk and get it as close to break even as possible to let the rest kind of take care of itself. So hopefully that answers your question. Again, if you have any follow-up questions on that, we can, keep diving in on this.
Nope, that helped a lot. Thanks.
Cool. All right, guys. Well, again, we'll see you next Monday, 5 o'clock. Next week, we'll do more on chart reading. And hopefully you guys found this helpful.
Thanks, guys.
All right, guys. See you next week.